The Bank of England are forecasting that we're about to enter into the longest recession in over a century. These bunch of bankers are the guys that look at all of the country's economic data in order to influence how much money is in the economy and how much that money costs to borrow. And then they let all of us know the impacts of this through their Monetary Policy Committee, which takes place about 8 times per year.
Let's talk business, gentlemen.
Now, the reason why it's important to actually pay attention to what the Bank of England or central banks all around the world are saying is because it has a direct influence on financial markets. The reason being they don't just present information based on the here and now and what's going on today. And in actual fact, they're a little bit more forward-looking and actually post outlooks for 2023 and beyond. And as I said, that's not just for us guys over here in the UK, but countries all around the world have their own specialised central banks too who do the same job. Like most of you have probably heard of the Federal Reserve before, which essentially is the US equivalent to the Bank of England, who again have that direct influence on the economy and financial markets. So as investors, it's important for us to understand and analyse not just what the Bank of England is saying, but the actions that they're taking along with the future forecasts that they're putting out as well. The reason being, well, it can give us a better idea of perhaps the short to medium term outlook for the economy and financial markets, which obviously has a direct influence on the value of our investment portfolios. So look, here are the most recent headlines from the Bank of England.
Today we've increased bank rate by 0.75 percentage points to 3%. This is the 8th consecutive increase in bank rate since December of last year. We've raised rates by a total of 2.9 percentage points during that period.
Now, fortunately for us, money's been cheap over the course of the past decade and a bit, with the central bank base rate being just 0.1%. However, things are now about to change. And whilst the 3% central bank base rate that we have today probably feels like quite a harsh reality, driven by the fact that we're so used to having a central bank base rate at 0.1%. As I said a few videos back, actually, if you look at the longer term data of the UK central bank base rates, actually the longer term average over the past 3 centuries or so is closer to about 5%. So actually, we're still well under the average base rate of interest. And actually, just a couple of days ago, I was in a meeting with one of the CEOs of one of the largest banks over here in the UK, and he's obviously well in tune with the Bank of England and financial markets on the whole, and he's only expecting the central bank base rate to rise to about 4 to 4.25%. So this isn't going to be a situation where central bank base rates become absolutely out of control, but I do certainly think there's still a little bit more headway for rates to rise over the coming months ahead. And as harsh as this may be, there is a very good economic reason for the central bank to actually continue to increase interest rates.
Well, quite simply, we're increasing bank rate because inflation is too high. And it's the bank's job to bring it down.
Now, the Bank of England target inflation rate here in the UK is 2% per year. However, as of right now, we're seeing inflation of 10.1%, which you can see is largely driven by the increase in petrol and energy prices, but also from the cost of goods increasing too, which unfortunately is largely down to the fact that the UK actually imports so much of their goods from abroad. And the reason why this is contributing to inflation is pretty much down to a weak currency, with the Great British Pound devaluing 11.7% against the United States dollar, and we're even down a couple of percent against the euro in the past 12 months. It's made bringing goods into the UK from abroad certainly expensive when we're paying for them in Great British pounds, hence the higher levels of inflation. However, the Bank of England have also provided a forecast for the inflation rate for 2023 and beyond. And actually, the picture does certainly get better. It certainly suggests that inflation is actually close to its peak, and that it will probably remain above 10% in Q4 and Q1 of 2023. But beyond this point, we can certainly expect a sharp decline back to the 2% target, perhaps in the more medium term. But by 2024 and into 2025, we could even see deflation, where prices could actually be falling rather than rising year on year, which is quite the economic phenomenon. Now, you might be thinking, well, in that sense, what's the short-term impact on me? Well, I think the obvious thing to call out is with inflation persisting for now, interest rates will obviously continue to go higher. And as such, one of the most concerning areas for most people right now, myself included, is the increase in interest on our mortgage repayments. We've all heard about the 2-year fixed rate mortgage rising to over 6%, which is the highest that they've been since the financial crisis of 2008. And naturally, a lot of people are concerned about the increase in payments when their fixed rate mortgage terms come to an end, perhaps in the next few months or perhaps even into next year. Now, from my point of view, it very much feels like the retail banks are very much hedging their bets with fixed rate mortgages up at about 6%, despite the fact that central bank base rate is only currently 3%. It certainly feels like they're pricing in almost a 4 to 5% central bank base rate in order to justify those 6% rate of interest on fixed rate mortgages. However, and again, this is just a personal view, it's certainly not financial advice, but I personally believe that if inflation becomes under control into 2023, and that if the inflation rate starts to come down quite quickly, then I think what we'll probably see is central bank base rates actually start to taper off perhaps in the medium term. And I think certainly that the retail bank mortgage rates will also start to taper off too. Now, I don't suspect that the central bank base rates will come down as quick as they've gone up, because that again could also create economic instability. But I think once the economy starts to stabilize, perhaps we start seeing more positive GDP growth rates, then I think at that point rates will potentially start to come down too. And interestingly, the Bank of England chairman kind of summarizes this with retail banks perhaps pricing in the worst case scenario.
But based on where we stand today, we think bank rate will have to go up by less than currently priced in financial markets.
So even right now, the Bank of England chairman is saying that actually central bank base rates might not actually rise to what financial markets are actually expecting. So hopefully that new expectation can be priced into mortgage rates too, although I doubt that will probably happen. So look, with all of these adverse economic conditions, where does that leave us for the rest of 2022 and into 2023? Well, I think we're certainly going to have a fragile economic environment in the next 12 to 18 months. Based on economic forecasts, UK GDP, which in essence just is the collective output of the UK economy, is certainly set to fall in the future, with the likelihood being that there will be a continued contraction of the UK economy into 2023. And this is where you started to see some of the headlines about the longest recession on record starting to come into the media in this very challenging environment. The knock-on effect of lower levels of economic output is that businesses start to make less money, and therefore they can't afford to pay their staff anymore, and therefore unemployment starts to rise, with forecasts suggesting that we could see unemployment rates up to about 5 to 6% by the end of 2023. Now, for context, unemployment rose to about 5.6% after the financial crisis of 2008, but it did go on to peak in 2011 at about 8%. On top of this, house price growth is certainly expected to decline, with Lloyds Banking Group suggesting that we could see an 8% fall in house prices during 2023. But some media outlets are actually presenting a worst case scenario that house prices could fall up to 18%, which of course is great for first time buyers if you're able to perfectly time the market. However, most of that benefit from falling house prices unfortunately will be largely offset by the increase in mortgage rates which we've seen, which are now well over 6%. So in actual fact, the chances are you might not be any better off on a monthly basis anyway. The out and out result of all of this is that consumer confidence and personal finance situation expectations are at their lowest point in a quarter of a century, and are actually worse than that of the financial crisis of 2007. So look, the truth of the matter is the economic outlook for the rest of 2022 and into 2023 isn't great. And that's not me trying to spread doom and gloom and fear on the situation, it's just the reality that we find ourselves in. But I think it's also important to emphasize the point that there will be opportunities during these challenging times. The first one being you'll be able to acquire assets for lower prices than what they were before. And therefore, if you're in the position now where perhaps you're sat a little bit cash heavy, this could be the fantastic opportunity that you've been waiting for to deploy some of that cash into different asset classes, perhaps into property, perhaps into equities, because it will pay you a huge dividend over the long run. Even if we take a look at the outlook for equity markets, they actually still remain positive. And don't take it from me, take it from JP Morgan's chief global strategist.
And, we're looking for about an 8% long-term gain out of equities in the US, more than 10% in Europe, emerging markets, and Japan. So I'd say this is a time to be overweight equities for a long-term investor.
So now being overweight on equities seems like quite a good bet. With value now certainly coming back into global markets, you've got like the FTSE 250 trading at just 11 times earnings when it was trading at 57 times earnings during 2020. The same goes for the US market as well, which is trading at just 23 times earnings versus the 54 times earnings in March of 2021. So look, value is certainly coming back into global equity markets as of right now. And from my opinion anyway, I think it's only a matter of time before we actually return to perhaps more bullish momentum within the stock market on the whole. And the reason why I say that is because I believe that the stock market and just global equity markets on the whole have actually already priced in a lot of the economic uncertainty that we're experiencing in the here and now. And the truth of the matter is that once perhaps inflation becomes more under control, we start to see global economic stability, actually the prices of equities will actually go on to rise again. And we kind of saw a little bit of this come into play already when we saw US inflation data come out last week, which came in lower than expected at 7.7%. And the result of that being the stock market actually went on to have its single biggest day rally in 2 years, with the S&P 500 jumping 5.73% in just 24 hours. So if we can see the same economic conditions over here in the UK, then hopefully UK equities will also go up on that same trajectory too. So look, I think it's going to be a tough couple of years ahead in the economy, perhaps even in the stock market too, but there is certainly value coming back into play. And with that being said, if you're able to deploy cash into the market to take advantage of these opportunities, your future self will thank you for it.